choppy down day here today?
I think we could have another, choppy day. I mean, the market is opening lower as well. We've called it for the last hour or so. Again, relating to the losses that we've seen in the Nikkei, 5% losses you've seen, those losses accelerated in the afternoon session. And there's a lot of data out today that we've got to focus on, particularly the US GDP figures out later on this afternoon. That's going to take a big focus here in Europe.
Okay, we'll get to the GDP in a second, but the losses that we've seen here in Europe, they're about a fifth or a quarter of what we're seeing in Japan. Do you think that will accelerate?
Well, Japan's a little bit of a different situation. Obviously, you've got a few things to take into consideration there. Obviously, look at the way that the dollar-yen's traded as well. That's had a bit of an impact. A lot of people, obviously, are relating those Nikkei losses to outlook on the Fed, for instance. And here, a little bit more settled because a lot of people are looking at the Fed for the GDP. I know we're going to talk about that in a split second. But we have already had big losses that we saw yesterday on the FTSE 100 as an example. And at the moment, I think a lot of people are kind of just treading water a little bit and seeing which way the data goes, because that will help them to clarify the chances of a Fed pullback on stimulus. Okay,
now this US GDP is Q1 numbers, no change expected from the 2.5% annual rate. But there's a school of thought that suggests that if it's to be revised higher, so stronger growth, might actually be negative for the markets.
And it would be the first time, in fact, for longer than I can remember, a good couple of years really, because what we've had in terms of sentiment for economic data lately has been good news is great news and bad news is good news, because bad news obviously indicates higher stimulus. Now, this could be the first time that we actually find out that good news could actually be, in the short term, bad news for the market. So it's going to be very interesting, although we're not expecting any change, and you do rarely see a change from the second reading to the final reading of GDP. So I wouldn't expect too many surprises, but do be warned if we do see a higher print, maybe 2.7, 2.8%, that may actually unsettle the markets in the short term.
June's almost upon us, and you've got some interesting research which suggests June will be a negative month, will be a bad month for the stock market investor, particularly here in the UK.
There's a lot of different situations that's actually combining quite opportunistically at the moment. You're right, I mean, of the last 22 years, the FTSE has been bearish, 73% of the time. In the month of June, from the start of June to the end of June, the FTSE has been bearish 73% of the time over the last 22 years. Average loss is 1.4% or 61.1 points. So if you look at where we are in terms of the broader market, the rally that we've seen from the April lows have been very sharp and very aggressive. And I get the feeling that a lot of people out there want to buy into the market, but they're waiting for a correction to give them the opportunity to do that. I do think a 5% correction on the FTSE would be actually quite healthy in the longer term trend of the rally that we've seen. And that could actually happen in June, yes.